Picture yourself with the investment savvy of Ray Dalio, the innovation mindset of Steve Jobs, and the market instincts of George Soros. How would you approach building wealth and spot opportunities others miss? Welcome to our journey of decoding the wealth algorithm used by financial titans. In this eye-opening documentary, we're pulling back the curtain on the thought processes of these masters of money. We'll dissect their decision-making frameworks, unpack their risk management strategies, and reveal the psychological edge that sets them apart. Get ready for a masterclass in wealth creation from the greatest minds in finance. 1. The Millionaire's Mindset: Decoding the Psychology of Wealth. Welcome to the fascinating world of millionaire psychology, where the real secret to wealth lies in the mind, not just the bank account. We're about to uncover the hidden patterns in millionaire thinking that set the ultra-successful apart. This isn't another feel-good story about positive thinking, but a deep dive into the brain rewiring that can transform an average person into a financial powerhouse. Meet John, a regular guy trapped in the daily grind, believing wealth was for others. He worked his 9 to 5, lived paycheck to paycheck, convinced his financial situation was set in stone. But fate had other plans. One rainy afternoon, John found himself in a dusty used bookstore, seeking shelter from the downpour. As he browsed the shelves, his fingers brushed against a worn leather spine. The title caught his eye: The Millionaire's Code. Intrigued, he pulled it from the shelf, the musty scent of old paper filling his nostrils. As he flipped through the yellowed pages, a pattern emerged. This wasn't about fancy investments or stock tips. It was about how millionaires viewed money, risk, and the future. John's heart raced as he realized he'd stumbled upon a hidden code: the millionaire's mindset. At the core of this mindset is seeing abundance where others see scarcity. Millionaires don't fight over a limited pie. They envision baking more. They perceive risk differently, viewing it as a stepping stone to success rather than a pitfall to avoid. This approach ties into their mastery of delayed gratification, sacrificing immediate pleasures for future wealth. But perhaps most surprising is their hunger for knowledge. Self-made millionaires constantly seek new insights, reading voraciously and surrounding themselves with experts. This continuous learning helps them spot hidden opportunities and adapt to market shifts. As John absorbed these principles, he began applying them to his life. He challenged his assumptions about money and success, looking for opportunities in unexpected places. He cut back on unnecessary expenses, channeling that money into his own education and side projects. There were moments of doubt. Late nights poring over business books instead of watching TV. Weekends spent networking instead of relaxing. But John persevered, reminding himself he was playing the long game. Then, after months of hard work and mental reprogramming, John's breakthrough came. A small business he'd started on the side began to take off, generating more in a month than his yearly salary. But it wasn't just about the money. John's entire outlook had shifted. He no longer saw himself as a victim of circumstance, but as the architect of his own financial future. The dusty tome from that rainy day had unlocked a world of possibility, proving that sometimes the greatest wealth lies between the ears. 2. The Multi-Stream Money Machine: Diversification, Decoded. John's success with his side business was just the beginning of his financial journey. But truly wealthy individuals don't rely on just one or two sources of income. The world of millionaires is far more complex and potentially lucrative than most people realize. Welcome to the fascinating realm of multiple income streams, where the rich have cracked the code to financial abundance. Ever wonder why wealthy people seem to have money flowing in from everywhere? It's not magic, and it's certainly not luck. It's a carefully crafted strategy that's been hiding in plain sight for decades. The average millionaire isn't just sitting pretty with a single paycheck or even a thriving business. They're orchestrating a symphony of income sources that work together to create a harmonious financial masterpiece. Here's a startling statistic. The average millionaire has 7 different streams of income. While most of us are focused on climbing the corporate ladder or nurturing a single business, the truly wealthy are diversifying their income portfolio like seasoned investors diversify their stock holdings. These income streams fall into 3 main categories: earned, passive, and portfolio. Earned income is what most of us are familiar with. It's the money you get from your job or from actively running a business. Passive income is the holy grail of wealth building, where you make money with minimal ongoing effort. Portfolio income comes from investments. Let's examine these income streams through real-world examples. 1. Salary from their primary job or business. Sarah, a tech entrepreneur, built her wealth primarily through her software company. 2. Profits from side businesses or consulting work. Michael, a doctor, leveraged his medical expertise to consult for healthcare startups. 3. Rental income from real estate properties. Sarah invested in rental properties, providing stability during market fluctuations. 4. Dividend income from stock market investments. Both Sarah and Michael maintain diverse stock portfolios. 5. Interest income from bonds and savings accounts. This provides a steady, low-risk income stream for many millionaires. 6. Capital gains from selling appreciated assets. Michael developed specialized medical equipment, which he can sell for profit. 7. Royalties from intellectual property or creative works. Sarah earns royalties from coding books she wrote. These examples might seem out of reach, but anyone can start building multiple streams of income. It's about strategic planning, consistent effort, and a willingness to explore new opportunities. Here's how you can begin. 1. Assess your skills and resources. What talents or assets do you have that could generate income? 2. Start small. Don't quit your day job, but look for ways to monetize your hobbies or expertise on the side. 3. Invest in education. Learn about different investment vehicles and business models. 4. Build gradually. As you gain confidence and capital, expand into new income streams. 5. Reinvest your profits. Use the money from your first additional stream to fund the next one. 6. Stay balanced. Don't neglect any stream, but focus more energy on the ones showing the most potential. 7. Be patient. Building multiple income streams takes time, but the compound effect can be extraordinary. Remember, the goal isn't just to make more money. It's to create a resilient financial ecosystem that can weather economic storms and provide long-term stability and growth. 3. The compound effect, turning pennies into millions. Welcome to the fascinating world of compound interest, where a single dollar can transform into a fortune. It's not magic, but it's pretty close. This financial phenomenon has been shaping the wealth of the rich for centuries, and it's time we uncover its secrets. Compound interest is like a snowball growing as it rolls downhill. Your initial investment gathers more snow over time, earning interest on both the original amount and the accumulated interest. Unlike simple interest, which grows linearly, compound interest expands exponentially, creating a powerful wealth-building tool. The Rule of 72 reveals the incredible potential of compound growth. Divide 72 by your interest rate to see how quickly your money doubles. At 6% interest, it takes 12 years. At 9%, just 8 years. This simple calculation shows why starting early and finding higher returns can dramatically impact your long-term financial future. Time is the secret ingredient in the compound interest recipe. Consider this. If you invest $500 monthly at age 25 with an 8% return, you'll have over $1.5 million by 65. Wait until 35, and you'll end up with less than half that amount. The earlier you start, the more time your money has to grow. But don't despair if you're getting a late start. Increasing your savings rate, seeking higher yield investments, or delaying retirement can help you catch up. Remember, the best time to start was yesterday. The second best time is now. Let's look at some real-life examples of compound growth in action. Warren Buffett, the Oracle of Omaha, accumulated over 99% of his wealth after turning 50. His investing journey started at 11, but it took decades for his financial snowball to reach massive proportions. Another example is Benjamin Franklin. In his will, he left £1,000 each to Boston and Philadelphia, with the condition that the money be invested for 200 years. By 1990, each fund had grown to over $5 million, showcasing the incredible long-term potential of compound growth. To maximize the compound effect, start early, reinvest your returns, seek higher rates of return while managing risk, and be patient. Strategies like dollar-cost averaging and using tax-advantaged accounts can supercharge your compound growth. Dollar-cost averaging involves investing a fixed amount regularly, regardless of market conditions. This approach helps you buy more shares when prices are low and fewer when they're high, potentially boosting long-term returns. Tax-advantaged accounts like 401ks and IRAs allow your money to grow tax-free or tax-deferred, effectively increasing your rate of return and accelerating compound growth. By understanding and harnessing the power of compound interest, you can set yourself on the path to long-term financial success. 4. Risk management, the millionaire's insurance policy. Welcome to the fascinating world of risk management, where millionaires turn potential disasters into golden opportunities. You might think the ultra-wealthy live in constant fear of losing it all, but the truth is far more intriguing. They've cracked the code on how to sleep soundly at night while their fortunes grow. So how do they do it? Millionaires embrace risk, but not as reckless gamblers. They've mastered the art of calculated risk-taking, seeing it as a crucial ingredient for wealth creation. Mark Cuban, billionaire entrepreneur and Shark Tank investor, says, "If you're prepared and you think you can do it, it's not a risk. You just have to figure out how to get there. There's always a way." This mindset shift applies to everyday decisions too. Whether you're starting a business or investing in stocks, preparation and confidence can transform seemingly risky moves into strategic opportunities. So how do the wealthy actually manage risk? They use a multi-pronged approach we'll call comprehensive protection strategies. First up is diversification, but not just across stocks. The rich spread their wealth across entire asset classes, industries, and geographical regions. They might own stocks, bonds, real estate, precious metals, and even cryptocurrencies, creating a financial safety net. Next in their arsenal are sophisticated insurance products and legal structures. We're talking way beyond basic car insurance here. The wealthy use liability insurance to shield against lawsuits, key person insurance for their businesses, and even specialized policies for rare art collections. Trusts and limited liability companies, LLCs, act like force fields, separating personal assets from business liabilities and ensuring smooth wealth transfer to future generations. When market volatility strikes, the rich use hedging strategies that might seem counterintuitive. They might use options contracts to protect against stock losses or invest in assets that move in opposite directions. But here's where things get really interesting: anti-fragility. Imagine a phoenix rising from the ashes, not just surviving but growing stronger with each challenge. That's anti-fragility in action. The wealthy don't just aim to be resilient in the face of chaos, they position themselves to thrive on it. This might mean investing in rare skills, building adaptable businesses, or keeping cash reserves to pounce on opportunities when others are forced to sell at a loss. Take Ray Dalio, founder of Bridgewater Associates, the world's largest hedge fund. His famous all-weather portfolio strategy is designed to perform well in any economic climate. Dalio doesn't try to predict the future. Instead, he builds a robust system that can handle whatever the market throws at it, turning potential threats into opportunities for wealth creation. The millionaire's approach to risk management isn't about avoiding risk altogether. It's about understanding risk, preparing for it, and even using it as a tool for growth. They've learned to dance with uncertainty, transforming what scares most people into a powerful wealth-building strategy. 5. The generational game. Strategies for long-term wealth preservation. You've mastered risk, but can you master time? We're about to dive into the ultimate challenge faced by the wealthy, preserving their fortunes across generations. Imagine building an empire only to see it crumble in your grandchildren's hands. The truth is, most wealthy families lose their fortunes by the second generation, with an even more staggering percentage failing by the third. These aren't just numbers. They're the shattered dreams of countless families who thought they had it all figured out. So what's going wrong? The answer lies in a complex web of factors, but financial education stands out above the rest. Many wealthy parents make the mistake of sheltering their children from the realities of money management, robbing them of the skills needed to maintain and grow wealth. Enter the family office, a secret weapon of the ultra-wealthy. These specialized firms manage everything from investments to tax planning, ensuring that family wealth is preserved and grown over generations. Take the Rockefeller family, for example. Their family office, established in 1882, has helped maintain their vast fortune for over a century. But it's not just about hiring smart people to manage your money. The most successful family offices focus on educating the next generation, teaching them not just how to spend money, but how to make it work for them. Estate planning and tax optimization play crucial roles in this generational wealth game. The wealthy create intricate trusts and legal structures to protect their assets from taxes and potential disputes. They use sophisticated techniques like generation-skipping trusts and charitable foundations to minimize tax burdens while maximizing the wealth passed on to future generations. Let's look at some families who've truly mastered this game. The Rothschild family has maintained its wealth for over 200 years by following a strict set of rules, including requiring family members to work in the family business. While we're not suggesting you follow all their practices, there's a lot to learn from their dedication to preserving wealth. On the flip side, the Vanderbilt family serves as a cautionary tale. Once one of the wealthiest families in America, they lost most of their fortune within 2 generations due to failed diversification and a lack of work ethic in their children. This failure underscores the importance of not just accumulating wealth, but also teaching future generations how to manage and grow it. So what's the secret to multi-generational wealth? It's about creating a legacy through a 100-year family wealth plan. This involves creating a family mission statement, establishing clear governance structures, and fostering a culture of financial responsibility and entrepreneurship within the family. It's not just about preserving wealth. It's about growing it through diversified investments and encouraging new ventures in each generation. One key aspect of this plan is encouraging entrepreneurship within the family. Instead of simply handing down wealth, successful families often create funds to invest in the business ventures of younger generations. This not only potentially creates new wealth, but also keeps the entrepreneurial spirit alive across generations. 6. Conclusion. We've cracked the Millionaire Code: wealthy mindset, multiple income streams, compound growth, risk management, and generational wealth preservation. But knowledge alone isn't enough. Are you ready to act? Every self-made millionaire started where you are. No secret advantages, just relentless application of the algorithm. They built diverse income streams, harnessed compound growth, and took calculated risks, planning for long-term prosperity. So what's holding you back from becoming the next millionaire? The blueprint is laid out. It's time to rewrite your financial future. Can you envision your success story? The first step is yours. Are you ready to transform your life? If you like this video, don't forget to like and subscribe for more informative content. Thank you.